The objective should be simply to get as much money as possible into a policy with the least amount of insurance. Now, isn't that the absolute opposite of how most people shop for life insurance, right?
Absolutely.
How much can I get? I want the smallest premium. How much can that get me? That's how we think because we're classifying it as life insurance.
Welcome to the Bankless by Design podcast, where we rethink money, ditch the system, and rediscover what it means to truly thrive well. I'm Trisha Miller, mom of 7, financial coach, and founder of ThriveWell. Around here, we believe wealth is more than numbers. It's about freedom, stewardship, and building a legacy that lasts. If you're ready to challenge the norm and take back control of your financial life, you're in the right place.
Welcome back to the Bankless by Design podcast. Last week in part 1 of Creating the Entity, Becca Wilhite joined me as we worked through Nelson Nash's argument that whole life insurance has been fundamentally misclassified. We looked at how life insurance developed from term insurance into whole life and how that changed the major characteristics of the product and why Nelson could ultimately say it might have been better named a banking system with a death benefit thrown in for good measure. And of course, we also talked about the potato. The Spaniards went looking for gold, found something they didn't recognize, and initially thought it was poisonous. Little did they realize that they really did find gold. It just didn't look like the gold that they were expecting. But now Nelson moves into the part of the chapter where we look at the composition of the entity. How does Nelson recommend that we design a policy? And ultimately, a system of policies specifically to perform the banking function in our lives. And one thing I also really appreciate about this conversation with Becca, and I hope you will too, is that it's just that, a conversation between two friends who are both practitioners, students of Nelson, and both of us willing to be honest about the places where we still have questions. We're not pretending to have everything neatly figured out before we start talking. We're working through the text together, challenging our own assumptions and trying to understand what Nelson is actually saying. And this is where we ran into a sentence that caused both of us to pause for a moment. So in part 2, we're going to wrestle with what Nelson actually means and then move into paid-up additions, the MEC line, capitalization, and why he says we ultimately need a system of policies to do the job. And we might have ended up going down a couple of bunny trails as well. Nevertheless, I hope you will gain something from it and enjoy our transparency. So let's jump back into my conversation with Becca right where we left off. All right. He returns us then to the scale of policies, and there is another graph on this page. And on this graph, it shows the single premium policy on the far left, a term insurance policy on the far right, with the modified endowment contract or the MEC line closest to that single premium policy. And then 20 pay, life paid up at 65, and ordinary life in the middle. So that's my best way to describe it for people who might not be actually looking at the page. This is where we got into the shorter payment. Ooh. Do we want to tackle this?
I do. As I have read Becoming Your Own Banker multiple times and need to read it multiple times again, I'm always finding little things that Nelson said that I just at first glance think, I think he made a mistake, or I think that's wrong, or I don't understand that, or why would he say that, right? And
hang on,
so
can I back you up just a second? Because I want you to hold that thought. Don't lose that thought. I'm just going to introduce this so that the paragraph we're talking about is understood. So I'm just going to read you this little section because this is the section that I put a question mark next to that caused Becca and I to have a little bit more conversation about this particular chapter. And it says, returning to the scale of policies above, suppose that the insured was 25 years old, then the ordinary life policy would be a 75 pay plan. The payment plan could be shortened by buying a life paid up at age 65. For the same 25-year-old, this would be a 40 pay plan. It could be further shortened to a 30 pay plan or a 20 pay plan. And here's the sentence. The shorter the payment period, the better suited it is for the purposes of the infinite banking concept. So I'm just going to explain to you that my understanding has always been pay as much premium for as long as possible for the purpose of the banking function. So I put a question mark next to this section. This isn't the only section in Nelson's book that I've put a question mark, but this is what led to our discussion. So Becca, I know you have some thoughts on this that I would love to have you share with us.
Yeah, I too have question marks that I have put in Nelson's book, but so far, every question mark that I've put, if I went back and tried to read it in context or think on that or wrestle with that a little bit or try to rethink my own thinking. So far, the problem has been me, not him. So I think this is one of those places where you could kind of cherry pick out, oh, well, look, Nelson said this, I should just do a 10 pay. I should, the shorter the pay period, the better it is for infinite banking. But you also have to think about how Nelson teaches, and he's very deliberate in building one idea on another, right? So he hasn't even introduced anything so far about how you would design a policy for this. So far, he's just covered the history of life insurance. They created this new thing called ordinary life, right? Which, I think we would just call a plain vanilla whole life policy, right?
Mm-hmm.
And now he's saying if you took that and you wanted to bank with it, that would be kind of difficult because it takes it so long to really have any accessible values, right? It would be a really long time before you could start using it. So, but wait, if you shorten it down to 30 years, 20 years, 10 years, well, now it's kind of brought all those values forward. It builds cash value quicker, and you could probably use a ordinary, a all base, plain vanilla, whole life policy,
A
paid
10
up in 10
pay.
years.
Mm-hmm.
And that would actually be pretty, you could bank with that right now.
It'd be very expensive.
A lot of capital up front, right?
Mm-hmm.
But I think he's saying with what we've covered so far that you could do this, but that's not the end.
Right.
What does he go on to say?
And even before you say that, because when you were saying this, my immediate thought was, this is why most people say you can't do that. You can't bank with it, because when you're looking at ordinary, plain vanilla whole life, you have 2 or 3 years, at least in the beginning, where you have zero cash value. It is so long and slow before you see any growth at all. And that's where people are looking at it and go, why would I put my money there? It doesn't do anything. So yes, absolutely. I do think you're onto something here, that this is him just building a case, but he's going to go on now to include the idea of a paid up additions rider, which is going to change everything with the way it becomes capable of banking function. And of course, he does mention the modified endowment contract in the middle of all of that. But as far as the design of the policy, he's adding a paid up additions rider. He goes on to say, when using this type of life insurance to solve your need for banking, it is best to select a plan. The base policy, now he's getting specific about that is in the middle of the scale. And of course, at the middle of the scale here, we're looking at probably life paid up at 65 policy on this particular, or the 20 pay life policy, and add a paid up additions rider to the plan.
I would even say here he also mentions the ordinary life, which would be, in his example, the paid up at 100. So I think he's saying, here's your kind of your sweet spot. We want to go at least to 65, 75, 100, right? It seems like he's contradicting himself, but I think what he's doing is he's saying, okay, but we can design this for this specific purpose, and here's what you would start with to add this paid up additions rider to it
on top
and
of
make
it.
it the most efficient.
Yeah. Right. Okay. Because by varying the amount allocated to each portion, base and PUA, you can place the resultant policy at any point between the base policy and the MEC line. The whole idea is to snuggle up to the MEC line, but don't cross it. So I feel like we do need to define the MEC line, short for modified endowment contract, which is new IRS rules as of 1980, 81?
80, something like that.
So the IRS has come in with these new rules and said, if you put in a certain amount of premium that is disproportionate to the amount of the death benefit, then we are going to no longer recognize this as life insurance. Now we're going to classify it as a modified endowment contract, which now becomes a taxable entity, just like your 401k or your IRA.
So they basically came in and said, this has to still look like life insurance.
That's right.
And the way you guys are doing it, it looks like an investment. And so we're going to tax you like it's an investment.
That's right.
So that's what that, and Nelson, he talks about in here where a modified endowment contract, he says it's not a matter of earth-shaking consequences, but it can be avoided with just a little bit of understanding and of knowing what's going on. And he says this, he says, why bother crossing that line and having a modified endowment contract when you don't have to?
You don't have to.
Because, and I think the draw for people of that idea is, oh, but I could have all this liquidity. I could have all this cash value in that situation, or,
Up front.
crossing that line up
Mm-hmm.
front. But he says here, I think this is really important. He says, after all, we're not attempting to accomplish all of our banking needs through the device of just one policy. We'll need a system of many policies in order to do the complete job. So I think that's important in coming into this, of knowing this isn't about a policy.
Mm-hmm.
It's not like I have a whole life insurance policy that I can borrow with a loan function or a loan provision. So now I'm doing infinite banking. Well, that's a start, right? But he never intended that to be the end of it. He's like, this is going to be a system. This is going to be multiple policies that are all working together over the course of your lifetime. So you don't have to worry about squeezing everything in up front. Like, just be a little patient, which is hard for us as Americans, I think, sometimes.
Don't be afraid to capitalize. Take your time capitalizing. That's right.
That's hard for a lot of people to accept.
And at the same time, while he's saying it's not the end of the world if it does become a modified endowment contract, just a couple of chapters earlier, he's like, avoid Willie Sutton, right? Mm-hmm. Sutton's got their hand right there to take from you. And of course, that is going to affect the growth of your wealth. So why would you do that if you do not have to? So doing this, snuggling up to this MEC line, he says this will de-emphasize the immediate death benefit, but accentuate the banking qualities, the cash values. The irony is that doing it this way will result in providing more death benefit at the point where death will probably occur than with any other plan. So when we start people out in one of these policies, it does look like a lot of premium for a smaller amount of death benefit, which is why we often will look at your human life value and set a convertible term alongside this policy to make sure you have the coverage that you need for your family now. So that is a place where term insurance is very appropriate, right? It's a placeholder until this other policy grows larger, but also then we can convert that term into a whole system of policy. So it works out beautifully. But the fact that it will actually grow to more insurance, we've had people say that, oh, Nelson didn't care about the death benefit. No, that's not true at all. All premium purchases death benefit. Cash values must rise to meet the death benefit. So it's the driver of the engine. But by de-emphasizing the death benefit, you will actually wind up with more death benefit than you know what to do with, or that the life insurance companies would originally give you in the first place. So
yeah, he says we're using this type of insurance to solve your need for banking.
Yes.
It's like, if you'll solve for banking, if you'll solve for the correct variable, then you're gonna get everything else thrown in with it, right? If we're just solving for how much death benefit can I get for the smallest amount of money, well, then we're back to that original term policy 200 years ago, right? Where we have all this death benefit, but it's at the point of life that we're probably not going to use it, right? And so Nelson's just saying, if we could have a system where we could use it along the way and have the death benefit when we're actually going to pass away, man, that's the best of both worlds.
It's like
we're not having to choose
inside out and upside down thinking, but it's because of the classification. It's properly seeing what is actually there in the first place. I am just always amazed the more I study Nelson, the genius of this man and how it comes out in every page in this book.
Well, if this isn't, like you said, upside down and inside out thinking to what we've been taught, he says the objective should be simply to get as much money as possible into a policy with the least amount of insurance. Now, isn't that the absolute opposite of how most people shop for life insurance, right?
Absolutely.
How much can I get? I want the smallest premium. How much can that get me? That's how we think, because we're classifying it as life insurance. But if we classified it as, how do I transfer this capital into this new system that I'm building? I'm building a banking system. How do I get as much as I can over into this new system? Oh, well, we want to pay as much premium as we can, hopefully for the least amount of death benefit. Why? Because we want to add on to that system. We don't want to use it all up in one. Our insurability is finite, and it is a precious resource. We don't want to use it all up in one shot, right? So it's backwards, it's upside down. And on its face, maybe that seems a little crazy, but when you see how it all fits together and how you can use it, it makes all the sense in the world.
And Even this afternoon, Becca, I mean, I'm just going to make this confession because this is a constant having to think this way in every area of becoming your own banker. I was looking at my annual statement and thinking about, it's the 7th year of my first policy has just passed. And I'm looking at it and thinking, man, that's a really big outstanding loan that I have. And it can scare me. And then I think, I am misclassifying that. I am the banker now. That is an asset to me. As long as I'm an honest banker, that is bringing cash flow back into my system. Or let me think about it another way. I have enough cash value now to take over one last significant loan in my life. Okay. And I was thinking about that and I'm like, do I want to do that or do I not want to do that? I have the ability to do that if I want to, because again, as a banker, we have options, right? I can decide I'd rather keep the liquidity in my policy so that I have that for an emergency, for opportunity, or whatever. And at the same time, I would not hesitate near as much if I came across a real estate deal and I generated, I don't know, $500 a month perhaps on a rental property. That would be a pretty significant cash flow today for rental properties. But if I paid off that debt, I'd be doing the same thing. But I think about it differently. Because that debt is a loan instead of seeing it as a piece of real estate that's an asset.
Are you saying that we misclassify the loans?
Yes, that's what I'm saying. There are so many things that this requires you to rethink.
I've been guilty of that myself. And this is the way I had to think about it, the shift in my thinking, because I came from a Dave Ramsey background, do not be in debt, pay cash for everything, right? So this whole idea of, wait, what do you mean? I can have this loan balance and I don't have to pay it off this month. Like it's okay if it sits out there for a little, I'm paying on it, obviously, right? But it's okay to have that there because I just don't like seeing it. I don't like seeing that number. And what I realized though was that in my previous way of doing things and the way we treated money as a family, trying to be responsible, trying to do the right thing, we would have just paid cash, right? And I wouldn't have had a loan balance, but that money would have been gone forever.
Right.
And in this new system, what that loan balance to me signifies is this is an opportunity I have to put this money back.
Yes.
And it's going to be as if I never touched it. And I'll pay a little bit of loan interest, but it's going to pale into comparison to what I was doing before, which was always restarting the compounding curve. Right? I would never got any traction because we were always paying cash and losing any ability for that money to grow in the future. Whereas now,
got to zero.
But we got to zero and I didn't pay anybody any interest. Now, I didn't have as much money, but I didn't pay any interest. So it's almost like that. Well, what do we really want? What is the goal? Right. Is the goal to not pay interest? Is the goal to not pay taxes? Or is the goal to have more money? To have more spendable dollars that we can go and bless, not just to consume on ourselves, but to bless others or bless our family or leave to the next generation or to causes that we care about, right? And so sometimes I think we even get the goal misclassified. Right. We focus on these little bitty metrics that we've been taught to measure that really aren't moving the needle in the grand scheme of things or even setting us back and we don't even realize it.
That's right. That's right. That's what I'm saying. Like even when he starts talking about this misclassification of a whole life insurance contract, I think there's misclassifications of every piece in this all along the way.
Yeah.
That we have to continually grapple with ourselves, even 7 years in.
Yeah. And I would say this too. Sometimes this just to be really real, like you're saying, sometimes I get discouraged and you have those doubts and you're like, oh man, is this working like it should? Is this working like I thought? Or did I just get completely confused for like 5 years of my life? And this was a really bad idea. No, but it's like I have to, when I go back to the source, there's so much noise. I guess this is what I'm saying. And Nelson talked about having to get noise canceling headphones, right? And not listen to all the noise out there. But every time I go back to the source and I look back to the things that the principles that he laid out, I'm like, yeah, this is based on certainty. This is based on sure things. And it's not the new shiny object and it's not the glittery thing that everybody's talking about, but it's time tested and it's weathered the storms and it's still around and it's still profitable. I'm like, I think that's where I want to anchor my ship is on something it's not only is that, but it's the whole foundation of how this is made is based on something that will happen. We will die. We will pass away. How much more sure can you get?
That's right. And so let me just close us up here a little bit with this last paragraph, because he just gives us a whole nother misclassification to think about. It all reminds me of the things such as when Christopher Columbus started his journey westward from Europe to get to the East. His destination in particular was India. But he arrives in the Caribbean and they meet some people on the islands they've never seen before, and they called them the Indians. They weren't, but the name stuck. It kind of cracks me up if you think about it. Like, how funny is this? And yet this has stuck. There are probably thousands of such examples of misclassification that we run into every day, but they probably don't increase the quality of our lives. Instead, they limit our thinking and lead us to wrong conclusions. And that's the danger of not really understanding what's really happening or what are the characteristics of those things. Words are powerful things. And of course, I love words. I know you love words too. And I always go back to this because in literary theory, this was drilled into our heads. Words do not just describe the world, they create it. I remember hearing that. And of course, I always think God spoke the world into existence through words. Jesus is the Word, and the Word is with God, and the Word was God. So it's just true. Words are powerful things. They create the world we live in. So if we have misclassified things, we have put words to things that are incorrect, we're living in a wonky world. It's a funny way to say that.
It makes me think of what Nelson said about securities. Like, why do we call them securities when it's all at risk? But
That's right.
It's like you're saying, that's what it's called. And there's got to be some sort of, at least, in the background of our mind thinking, oh yeah, that's a secure place. That's what they're called. They're securities. When
there's anything but secure. They should be insecurities.
Why do we drive in a parkway and park in a driveway? Like, all these things, our words don't make sense sometimes. So I don't know. I think we have to have enough discernment to look past what things are called and see what they really do, right? Because really nobody wants life insurance. Let's be real. Nobody wants life insurance, but everyone wants what life insurance can do.
Oh, I love that. Yes, absolutely. Name some of those things, Becca. What can life insurance do that they want?
Well, it's giving us a place to store money, right? We have to put it somewhere. It's giving us a guaranteed increase. It's giving us access to capital on our terms without having to ask permission from anyone, right? It's giving us a tax advantaged, or, depending on how you do it, tax-free increase on those dollars. And I think one other thing that it gives us from a mutual company specifically, I think this is overlooked sometimes, is just that idea of mutuality, that we're partners with the life insurance company. Like, we're on the same page.
We're same team.
We're on the same team. We're all pulling in the same direction. It's not like a zero-sum game where I win, you lose, you win. We're betting against the house.
We're rowing together to go across that finish line together.
Absolutely. Yes. And I think that can't be overstated, because in the financial world, I think that's very rare to have that scenario. It's usually you have a winner and a loser, and chances are everybody thinks they're going to be the exception to the rule. I'm going to happen to be
the winner.
Yeah.
Yeah. No, that's great. That's great.
I clicked on some video today and it was kind of like, I don't know, clickbait, I'm sure, but talking about we're predicting that mortgage rates are going to go up to the moon, in the 2030s or whatever. Who knows if they're right or not? But my very first thought was, okay, well, that means we need to really concentrate on building our system, because we're probably going to need to provide mortgages for our kids, that they can afford housing. It's like, instead of being fearful of that, oh, what are we going to do? It's like, wait, we have a system in place. All we have to do is scale, right? And we can provide for others that have a problem, right? That need access to capital, and we're able to provide that. And I think that's what
Isn't
it's
that a beautiful
for,
thing?
right?
We solve our own problems and now we have room to solve others.
Yeah.
It's just such a beautiful thing. I love it. Well, Becca, thank you so much for joining me today. It's been a joy and a pleasure as always to speak with you and for helping me walk through this chapter, creating the entity that isn't one that we spend a lot of time in usually. So thank you very much.
You bet. It was great to be here. And if you're still listening at this point, kudos to you. We've kind of waded through some deep waters here, and I hope you found some value in that.
Oh, I think we've found some wonderful value in this. I love just thinking through this idea of misclassification.
Absolutely.
All right. So thank you so much for listening. And I hope you've enjoyed this. I had fun. I hope you did too. And until next time, have a fantastic rest of your week.
Thanks for tuning in to the Bankless by Design podcast, where we're done with the system and we're doing money differently. Be sure to subscribe, share this episode with someone who needs it, and visit us at banklessbydesign.com to learn how you can start living bankless by design.